So before we get into what's happening with housing and some of the other key leading indicators for the housing sector, we wanted to, again, talk about then look at the expected new orders, because this is just showing where are you going to buy a house if your company expects this, if you're expecting it, because everyone's seeing it when you look at Michigan data, University of Michigan consumer data, when you look at buying a new home, worst time ever to buy a new home based on the conference board. So all of these things are, again, those leading indicators to, well, what is that activity going to look like? What are people going to do? And that's why we see, again, a lot of this is still growth. So we're still not talking about this huge drop off where we're going to go deep into a recession. It's just, this is how things kind of start, where you see this slowdown. Then the question is going to come, what happens on the fiscal side? What happens on the monetary front? And how much worse do we go? And how quickly do we go essentially from that inflation to what we think is going to be a stagflationary backdrop? So capital goods new orders, when you look at it, it's up. And then when you take out non-defense aircraft, you can see that it was slightly down. So March capital goods orders non-defense air was up at 1% versus the estimate of 0.5. Year over year, the trend has cooled considerably from peak, but orders are still expanding at 9.7% annual rate. Level continued to climb to an all-time high. So again, you're still getting some of that coming through. It's just you're getting a bit of that drop off. So then the next question is, well, March durable good orders came in at 0.8% versus the estimate of 1%. And then when you take out transportation, it came in at 1.1% versus the estimate of 0.6%. So you're still getting a certain amount of growth on the front, on the top end, but when you look at the year over year, again, you're starting to get a bit of that cool down. But some of these pieces are positives when you look at those new orders. So then, but it's being reflected where new orders were up. Not new orders. I'm sorry. When you look at what is happening right now from the PMI perspective is good, but then the orders going forward, the expectation is starting to weaken. So all of that is happening, and I think this was a great backdrop when you look at U.S. home mortgage 30-year fixed national average is at the highest level it's been since 2009. This is at 5.29%. It's actually closer to 5.35% now. So again, you're at the highest mortgage rate that we've been at in over 10 years. And I think that is a bigger concern for where things go over the next few months. And here's some of those leading indicators that we're going to look at. So when you look at the median price of new single-family homes, blue rose to a record $436,700 in March, as monthly supply, orange, moved up to the highest since 2008. So when you look at monthly supply, it's been going down, it's been getting worse, but now supply is coming back up. And those are number of new homes for sale. So now all of a sudden you have more homes for sale. Again, that's where you're starting to get some of these adjustments. There's usually an increase in March, April, May, because we're coming into kind of that peak period. But here's a lot of some of those underlying problems. New one-family houses sold total, when you look at it, it's still elevated but it's again below where it was for 2021. And typically you kind of get that increase in March, but instead we just actually came down from February. MBA purchase index readjusted. The new home sales, you get an idea that you're getting the mortgages are coming down. As that comes down, again, you're getting those new home sales coming down because people aren't applying for mortgages. Now, that's also leading to some of those leading indicators where the appraisal waiver. So an appraisal waiver is if you spend, if say the house is valued, or it's on the market for $700,000, and you end up buying it for $780,000. Well, if the appraisal comes in at $650,000, they don't adjust that, because they just say that the appraisal is a little bit slow, and you'll get a waiver on that, so you won't get penalized by having to put up more cash or getting a higher rate. That is coming down considerably. All of that just, again, showing to the concerns of where this is going to be going forward. And now again, that financial tightening, which we showed in segment 2, where they're just not getting, financial tightness, the financial conditions are getting a bit worse. U.S. mortgage rates, again, at that over a 12-year high. One of these is wrong. Can you find out which one? So rent is up 19%. Housing prices are up 19%, currently 20%, which we'll show on the on the S&P case Schiller, rent is up 17%, but the CPI for housing, the OER, owner equivalent rent, is at 4.5%. So you get an idea of where that pain is. All the while, inventory of new homes for sale, so under construction still remains high, completed still remains low, and not started remains elevated, which is why we expect to see more capacity coming on. But the problem is it's at a higher price. So new single family home prices, when you look at where they are, the biggest driver for new home prices has been construction costs. The producer price index for residential construction has risen 23.2% over the past year. When new home prices are adjusted for inflation using this price measure, the real median price of a new home has actually fallen about 1%. And that's some of those concerns that we have when we look at, well, when that house does come on, well, can the builder afford to give a cheaper price, or are they going to have to take a loss? And that's going to become some of the underlying problems when we look at leverage. All the while, purchase only. I love this. This chart is so scary. If you look at house price index just exploding while earnings, I should say, slightly ticked up. So earnings slightly up while home prices go through the roof. And that's why when you look at U.S. housing affordability for first-time home buyers and in general is falling through a floor. And this is leading to buying conditions for homes measured by University of Michigan remains at the worst ever on record. And then when you look at existing home sales median price year-over-year change, still elevated, but again, some of those leading indicators for pressure points. And then when you look at this separation between the two of consumer confidence, the orange, and then the conference board, the blue, is moving sharply lower, yet 2022 started with household net worth making up 826% of disposable personal income. So then when you look at net worth is technically higher, but yet the University of Michigan and conference board expectations are much worse. So confidence is down, but personal income and disposable personal income is higher. And again, it's because when you look at net worth, it's skewed because net worth has exploded for anybody that own their home or real estate, anyone who had a 401k or a stock portfolio. But now you're getting a lot of pain coming through, which again is leading to these additional pressure points, which is why that number is skewed to the upside, and it doesn't incorporate everyday Americans, but rather the top 10%, especially the top 1%, is skewing that number considerably. Then consumer confidence index came in at 107.3 in April versus the estimate of 108.2. Expectations component ticked up to 77.2 versus 76.7 prior, where present situation moved down to 152.6 versus 153.8, all again showing some of those headwinds that people are seeing. Home price gains picked up steam again in February as S&P Corelogic index rose to 19.8 versus 19.1% in the prior month. The 20-city index is up to 20.2% versus 18.9% in the prior month. All of that leading to why we're seeing such a big slowdown in sales, because mortgage rates are up, prices are up, who can buy? And that's why we're seeing some of these slowdowns, but as we've said before, there's also a certain amount of buyer hesitancy to lower prices because you're like, well, my next door neighbor sold his house for $20,000 more than what I'm listing it for. My house is nicer. So, and again, that's where you get some of these backdrops. National HPA for March 2022 averaged 16.6%, up from 16.4%. An analysis of home purchase contracts entered into early to mid-April indicates that HPA will continue to be in the mid-teens by the end of May. So again, all of those things leading to a bit more pressure. Americans are buying smaller homes, though. So as prices go up, people have actually shrunken where they're willing to go, where the 4 weeks ending April 10th, the average home was 1,720 square feet, which is down from 1,751 square feet same time last year. When the cost of goods rise, you consume less. With sky-high prices and rising mortgage rates, each square foot of space costs more than before. Buyers are compromising by buying smaller homes. New home sales came in down negative 8.6% in March versus negative 0.6% estimate. Largest monthly drop since April of 2021. Median new home prices rose 21.4%. Obviously, that's with the average selling price at $523,900. Month supply rose to 6.4% versus 5.6%. So supply is going up, price is going up, sales coming down. So get an idea of kind of where things are going, and then putting it on a chart on the mortgage side. You can see that the MBA purchase index is below 2018, 2019, 2020, and 2021. So it's below 18, 19, and 21, just giving you an idea of some of that pressure point. And then MBA refinance index is the lowest going back through 2013, because why would you refinance in where rates are today? U.S. transaction volume shown with pending home sales, again, all moving down in a negative way, with median single family existing home prices continuing to move up, again, keeping some of these pressure points. So that's what we have for you on the housing front. So things, again, they're wobbly. They're starting. We talked about it previously, but essentially this is confirmation of everything that we said essentially 2 to 3 weeks ago. And we're continuing to see that progress in that negative light, which I think is a bigger problem for kind of the direction of where the market is going and essentially the real estate in general. So that's what we have for you on the U.S. front. In the next segment, we're going to go to Europe and look at some of the pressure points that we continue to see only get worse in the European theater.